So back in 98, 99, and 2000, the poster child was Cisco. This is an exceptional business, amazing returns on capital, amazing margins, amazing top-line growth, was literally building the infrastructure for the dot-com boom, right?
So fundamental to the internet itself.
Absolutely, absolutely. It was literally the plumbing that made the internet work. And this is a business that could do no wrong, right? And was valued at a valuation that assumed that and then some. And this is where the danger comes in. I think a lot of conversations that I'm having today just are very reminiscent of the things that people used to say about Cisco in 98 and 99. And the truth is, they were right about how well Cisco is going to do and how well and how important it was to the boom. And if you look at it, and over the period from 2000 until 2008, for example, Cisco's profit grew at a 20-something annualized rate every single year on a compounded basis. Just exceptional levels of growth. Sales continued to grow, margins continued to expand. EPS grew at, I think, 20 or 21% per annum. And yet, if you own the stock, you lost 80% of your money. And you extend that period, even over 20 years, owning this phenomenal business where profits went up by almost 5x over 20 years, and yet your total return was zero over 20 years. Can you think about that? You own an exceptional business for 20 years, a business that can grow profit by 5-fold, and yet you make no money on this stock. And it just really, really drills in this lesson that yes, you want to buy great businesses, but valuation really matters. And if you end up paying a silly price for a business, just even if you wait for 20 years, you're still not going to get a good return.
But maybe this time it's different. Maybe Nvidia and AI is more revolutionary than the internet was. I'm not saying that it's not revolutionary, but I think if you look at the history of technologies, it's the same thing over and over again. These transformative technologies do transform the world. They're really revolutionary, as was the internet. Well, yes, I remember reading law, and I had access to LexisNexis, which meant I could access every case I needed on my laptop. Otherwise, I'd have had to have walked miles just in the library to go from one book to another. If I wanted 50 cases, that could be 50 different bookshelves I'm having to find. Yeah, that was very revolutionary. Yeah. But let's look at Nvidia, because that is what people are now saying is the new. Well, we're saying it's the new Cisco.
It's a brilliant business.
Brilliant. Yeah. But bulls will say, look, at 40 times EBIT, that's not that expensive for a business that's growing this fast. And it is growing fast. But I think what people are missing out on is their margins are estimated to be 65% next year. 65%. Now, their long-term...
Operating margins.
Their operating margins. Not their gross margins, their operating margins. Now, their long-term average is a third of that. Their recent average is about half of that. Yet somehow people assume that these margins are going to carry on for 5 years. Now, if they do, okay, fine. This business may be fairly valued. I think the street has it on 15, 16, 18 times 2028 earnings. Actually, 2029 earnings. This is a long way out to be paying that much money for. Yeah. A lot can go wrong. But if margins revert, if margins go to, let's say, 30%, higher than normal, but 30, if growth isn't quite what it is, this business easily halves, possibly down 60. And with a bit of overreaction, this could be, well, it could follow the same trajectory as Cisco.
Yeah, I wouldn't be surprised because the margins that Nvidia are achieving today, the volume growth and the pricing that comes with it, is in a situation where you have a shortage of supply compared to demand, and they are the monopoly supplier of the goods being sold. You are going into a situation where there won't be a shortage because supply is coming online. Competitors are coming in. Competitors that are both conventional competitors such as AMD, but also some of their own customers, people who buy 50% of their product are getting into competition with them. Microsoft, Meta, Google, Amazon, they're all making their own chips. Some of them are already in production. Some of them are already being used. So you are going to go from a situation of a monopolistic business that has a shortage of supply relative to demand to a situation where you don't have a shortage and you have many competitors and other competitors that we don't even know are going to come in yet. And somehow margins are going to go up. I just do not think that is economically possible. There is no doubt in my mind that you're going to have margin pressure. You're going to have pricing pressure. Technology always behaves in that way, but basic economics behaves in that way. And so that sales growth from a volume perspective might be true because they are a great business, but I think pricing is probably not going to grow as much. Margins are going to compress. And then you take all of that. You start with a really, really high 30x plus sales multiple, and then you have a disappointment in terms of what sales growth or revenues are going to be. Margins get worse. And then, frankly, in that scenario, multiples also get depressed. I would not be surprised if the stock is down 70, 80% or more. I think this can continue to do really well as a business, but be extremely disappointing as a stock. And I think when it comes down, other businesses that have gone up based on the expectations of this AI revolution, and it is a revolution, will also be dragged down with it. And I don't know what is going to cause this to happen or when, but I have a very high degree of confidence that it will happen.